All right, welcome to Trading the Markets. This is Mitchell Joseph, free class edition. So what I was saying was, so let me actually show you guys what I mean. So the market took a really strong dive today, well, past couple of days. So this is the S&P 500, which represents the top 500 stocks in the market. But if you look at the last couple of days, you see like from what day was this? Monday. So last Monday, we're at 406 and we've just been steady falling. You know what I mean? But what I was telling you, Valsi, was that it's because of the bank run. Like, let me see if I can find the article. Um, SVC Bank. Yeah, it should be like one of the top stories. So let's see, this is the one. A run. So right here, a run. So a run triggered depositors panic, and they all rush to withdraw their funds. Sometimes it's triggered by false rumors, but that's basically what made the bank crash because they didn't have enough cash on hand to satisfy all the people just basically rushing it to get a deposit. So like that's what I was talking about, Valsi. I don't know if that clears it up for you. Yeah, but what I was saying was if you notice, they've been built out. A lot just like last time, just like they did in the Great Depressions when everybody rushed the banks for money. It was Rockefeller that and a bunch of investors that pulled their money together, and then they build out the banks to give them the money so that they didn't have to crash. And that's basically the same thing that's happening right now with SVC Bank, Silicon Valley Bank right here, and many other. There's another bank that fell today too. So people are just afraid that more banks might fall overall. But let me get into the lesson. So I don't know if you guys remember last time. Remember I was showing you guys this last time? So let me ask you, V, how do you know if we're in an uptrend or a downtrend? How do you know?
Are you talking to me, Mitchell?
Yeah, boss.
Oh, how do we know we're up a trend or downtrend?
Yeah. What is the structurally speaking?
Oh, well, I think the candles, right? If it's going up, it's uptrend. If it's going down, it's downtrend, right?
Yeah, but also look at the highs and the lows.
Oh,
The
yeah, sorry, you're right
location of
about
the
the
highs
highs.
and the
Yeah,
lows tell you.
right.
So you notice how like the lows get so right here when you're in
And the lows get lower and
a downtrend,
okay.
the lows get lower, the
The lows
highs
get
get
lower,
lower.
yeah.
So as it's
Yeah,
moving along, you got to see where are the highs and where are the lows as it's moving. You know what I mean?
right.
But that's the main thing. The lows get lower highs and lower lows. So now for the uptrend, the opposite is true. The highs get higher and the lows get higher. You know what I mean? So
Right.
that's how you know if we're in an uptrend or downtrend because when you're making your trade plan, you want to first thing identify the trend. That's the first thing you want to do is know like what is the trend, and we got to look on the big picture and then work our way down into the little picture until like recent times to really understand the trend because depending on where you look at it, it's going to look up or down depending on how much time you're looking at. So, like in this chart right here, if I showed you this chart right here, are we on an uptrend or a downtrend based off what you see? Um, anybody could answer? Are we on an uptrend or a downtrend?
Downtrend.
Yep. How do you know?
Um, I don't know if I could say the same right. Is it the lower lows
Lower lows and lower highs.
and lower highs? Yeah.
Yep. It wasn't until right here that this low started getting higher than this low. So it looked like it started reversing, right? But now this low threatens this low. So once this low, if we break under here, it's whatever type of bounce that we were doing, it's completely invalidated. it's completely no longer valid once we break that, because then we will make a lower low. You know what I mean? Do you know what I'm saying? Because it's all about market structure. You got to look at how is it moving structurally. You know what I mean? So like, let me go back to the slide. So like, for example, right here. So remember how I told you guys about the head and shoulders pattern?
Yeah.
So notice that you see how quickly and strong it starts coming down, but notice it comes down strong, but then it comes up weak, right? So like let me annotate. So this is a strong move down, very, very strong, right? And then the move up is weak, right? Then it's a weaker move down, but then the move up is a little bit stronger. You see what I'm saying? So you can see that the down move is losing momentum before it reverses. You see what I'm saying?
Mm.
So literally it's like the reason why this pattern is a very strong pattern is because psychologically what it does, like it slows down the momentum. The pressure on the down pressure loses steam, and that gives a chance for the other side to start building pressure. So the other thing too, let me erase this. All right. So two things. So number one, notice how it was making lower lows and lower highs. The lows and the highs were getting lower, right? Getting lower highs, lower lows, lower high, lower low. But right here, it makes a higher low. You see that?
Yeah.
So that's a sniper entry right there. That's already a really good entry to get in right then and there. And another reason why it's a very good entry is because you have a small risk. Let's say it breaks down. You'd only be risking this small area for the potential of a lot more. You know what I mean? So it's a good trade because every time you trade, you want to risk small to win big. If you keep doing that, you can lose a lot of trades and still make money. Does that make sense to you guys?
Can you say it again? Sorry.
So anytime you trade, you want to risk small so that you can win potential. Your potential win could be big. So for example, if I got in right here, I would target the top of this move. And that would be where I would try to take profit. So now I have this big potential profit for this small potential loss. You get what I'm saying?
Yeah.
So every single time you trade, you want to make sure you get in at a place where you have a small loss, and it's easy for you to know you're wrong. Because once we break these, guess what? Now we're gonna make a lower low. So I'm gonna get out because I see structurally, I see that based off the market structure, this is where I'm proven wrong. So before you get into any trade, you need to know where you're gonna get in. More importantly, where you're gonna get out. Both if you're right, get out the profit target, and if you're wrong, get out the stop loss. But the main thing is just like this head and shoulders, you see that once the momentum starts to die down and you start to but you have to, so you can start getting familiar with this pattern. It's called head and shoulders. It's the upside down head and shoulders. This is the head, this is the left shoulder, this is the right shoulder. It can also look like this, where it looks like that. So it's a strong reversal pattern. So a lot of times, if price comes down here, at this point, it breaks it, it's going to keep going down for a bit. Same thing like right here. Here's a neckline. Once it breaks it, right here, it can keep going up for a little bit. Does that make sense to you guys? So basically, the way you play it is you look for the neckline, like where the neck is, and then you play if it breaks there. But it doesn't have to break. It might just bounce. So you got to wait for a reaction. Like right here, we got to see like how is it going to really react, you know? And that's why we waited for that to break. Or even right here, you could even see there's a smaller head and shoulders right here where you can call an earlier neckline. But I don't know. Anybody confused? Anybody got questions?
So you want to play it to the neckline. You want to pay attention.
Yeah, with head and shoulders, you want to play off of the neckline. You want to play off of the neckline. So the neckline is basically underneath the shoulder. So I can look at it two ways. I can look at its smaller view right here, where this is the beginning of the first head and shoulders, because right here it's right underneath the shoulders. That's neckline. I can also look at it a little bit bigger and play neckline off of here as well. You know what I mean? So one thing I want you to understand is when you look at the charts, it's subjective, but you got to be able to see the structure. Does that make sense? So there's two entries, like there's multiple entries, but both based off the neckline entry. There's a neckline right here, and then there's a neckline up here as far as like breaking the highs. You know what I mean? So, but the most important thing is understanding that once it starts making higher highs and higher lows, that shows that there's a beginning to be a reversal in the trend. And that's all I want you guys to realize. All right, and if you learn this pattern, it has a very high, about 80% plus win rate, follow through rate when you do it properly. And then this right here, very important. So when we're talking about reversals, we have to understand that the market moves best when it creates structure. What do I mean by structure? I mean, if a stock just goes straight up, it's going to go straight down. Why? Because there's no structure for it to have a support on. So you want to see stocks that go up, down, like a staircase. That's healthy movement. That's what you call healthy. So the fact that you see this right here didn't happen. Like this shouldn't have just went straight down. It should have went down, then went up, then went down, then went back up, then went down, then went go back up. Because what happens is, if this had happened, you see these points right here, when the market's coming back, it's gonna have a hard time getting through these points. You know, it's gonna have a hard time getting through. But since there was none of that, there were no ceilings on the way down, it's gonna have a straight up, easy way to eat through that price action from over here. Does that make sense? So the way the price came down over here without no structures and no pullbacks, it's going to be able to go up without no pullbacks and easily rip through it. Does that make sense to you guys?
Yeah.
And this is very, very important. So whenever you're looking for a play, look at the candles and look to the left to see, is there a lot of things that's going to stop you from moving? When you see a straight flush, you know it could be a straight rush right back up. But when it's up, down, up, down, up, down, slowly trickling down, that's gonna make it hard for you to go in the direction that you're trying to go in the future. Let me show you what I mean on the charts.
So when you go down, you have to wait all the way to see what's the pattern going to come up.
Yeah, you want to wait to see if it's gonna reverse, because it doesn't have to reverse. Like it could have came right here, right? Came right here, and then just went down.
Yeah.
So you gotta wait to see if it's gonna reverse. And how do you know it reverse? The structure has to change. It gotta stop making lower highs and lower lows and start making higher lows and higher highs. Once you see the structure started to change, you know that structurally it started to reverse. Does that make sense?
Mm-hmm.
And then if you know the head and shoulders pattern, you can play the neckline. Once it breaks certain areas, you'll know how to play it to get in. It's all about playing off the key levels. You gotta wait for it to break and hold levels. So now if we go to actual chart, let's see, what's a good example? Let me go to Ford, because I do a lot of markups on Ford. Like for a while, I didn't lose any trades on this. But the main thing is this. So okay, let's look at Ford. So look over here. I'm gonna annotate certain areas. So this area right here, notice how it was a straight flush down. Do you see that? You guys see the straight flush?
Yeah.
Look at the straight flush up, the straight rush back up. So if I was trading, right, let's say like, and here's a good thing, I can do market replay and go back in time. So let's say like I was right here, right? Let's say we only seen this, right? This is the point that we were at. So now Okay, so I have a couple things in place. So one, I have this zone right here that I made because this was a consolidated area that we made a big move from. So if we make a big move from an area of consolidation, there's a high chance that when we come back in that area, we're gonna bounce again. Does that make sense to you guys?
Yeah.
So because this is what you call a demand zone. You know, it's kind of like support, but it's based off of consolidation because the premise is that big money before they make their big move, they get in during consolidation little by little, not to make it hot, and then when they're ready, they let it rip. So now when they let it rip, there's a ton of orders that are still stuck down here because as their orders went up, the price got away from them. You know what I mean? So now when it comes back in that zone, there's a chance that if there's enough orders and enough buyers, because this is where buyers like to buy, that is going to do it again. But you got to wait for it to actually happen. You can't just say it's going to happen because it can also just break right through it. If the sellers are not strong enough, I mean, if the buyers are not strong enough and the sellers overtake the buyers, then it's going to go down. But at least there's a zone for you to wait for reaction. So for example, so right here, right, I see this candle right here. So this red candle right here, I see it's a hammer candle. Anybody know what the hammer candle means? This red candle right here? Nobody?
No.
So a hammer candle. So you got to remember, like in candles, this candle opened up here, so it opened at 10.95, came down, made a low of 10.50. Sellers brought it all the way back there, but guess what? Buyers said no, 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 and they brought it all the way to close, way closer to where it opened from than at the lows. It's way closer to the highs than lows. So this shows that there's momentum to the upside. This shows that the momentum went like this. It went boom, and then it came back up. You know what I mean? So now the next candle could potentially continue that momentum, potentially. So when you see so to me, it would be like, okay, it's a hammer candle right in the demand zone. So now all I'm waiting for is for a bounce. I need a green candle to close out of this zone. So right now, okay, it's closed a little bit, right? Like you see, like it kind of closed out the zone, but that's not enough. I need to see a stronger close out of that zone because this could do this and then drop right back. So with the stocks, you don't trust them. You want them to prove themselves before you do anything. So next day, look what happened. You know what I mean? So this is why you wait. Because imagine I got in right here. I'm like, oh, we're about to bounce. No, but not yet. You jumped the gun. You see that? So now you have to be patient. And all I'm waiting for is a strong candle close above that green area. A strong one. So let some more days go by. Okay. So you see a candle like this? I want a candle like this, but I want it out of the green area. You guys understand?
Yeah.
Because this is a strong, bullish, engulfing candle. So now I'm going to let it play, and I'll let you know when would be a good entry. Okay, so right here would be the entry. You guys see that? Right there would be the perfect entry in. Why? Because we bounced out of here, and we closed above this red candle. We opened above this red candle. So I would have hopped in the beginning of the day and just rode this. Just because we're out of the zone. Look, it retested the zone because you see the wick. That means at some point in the day, it came right back into the zone, tapped it, and it came right back up. So let's say I see it taps it, and then I see it starting to come back up. Once it's coming back up and it crosses the body or the high of this candle, I would enter right away. I will enter right here. I'll put my stop loss under the zone. So now I would risk this area to potentially at least get up to here. You know what I mean? So now notice a couple things. Notice the gaps. So you see like right here, let me annotate. You guys see the gaps right here? You see the gaps? Y'all see the gaps? So
yeah,
gap is weak structure. The same way I said when the price just moves quick in one direction, that's weak structure. It never built nothing. It just went straight down. So the gaps work the same way. So it's weak structure. So if you get a strong enough price to go back in this direction, most likely it's going to eat right through these gaps. If it's strong enough, it's going to eat right through these gaps. because like I said, this is not healthy. It's not a healthy move. It never built anything to stand on to hold it down. So now we're gonna let it play some more. Let's see. And you're gonna see how it moves.
Now, when you say getting in, you're talking about the calls, right?
Yeah,
So,
calls. Mm-hmm.
so would this also be good to get the puts also too around this time now?
It's you could, but the thing is, we're to get a put. If you hop in the put and you see we're right near demand zone, you don't have that much space where you need to take profit from. You know what I mean? You don't have that much space to get the reward. Do you get what I'm saying? You want so
Yeah.
like for
That's just
example,
for this one though, right?
yeah, just for this one. So like for example, like if I was to play puts right now, I would be worried because this green zone right here, it's like I would have to take profit somewhere in here. You know what I mean? So it wouldn't leave me a lot of room to take profit. And then I gotta put my stop loss in a place that makes sense. You know what I mean? So whenever you see this green and blue, the red is the stop loss. The top of the edge of the red is the stop loss, and the edge of the green is the take profit, and the middle is where you get in. So this is a way for you to let things play out and see how they would have played. So it's like I could even leave this right here and like let's say, oh, let me think it's gonna go down and see what happens the next day. You see that? I'm already stopped out of the play. I already hit my stop loss. You know what I mean? Does that make sense to you guys? You guys understand what this is right here?
Yeah.
Yeah. So this is how you can practice trading and backtesting without actually being in the trade. You can just put it right on the chart and see how it plays out. So the main thing is, remember I said the structure on this side is going to easily break through because there's not much holding it down as far as resistance. So that's why you can see it ends up playing out as such. Look how it starts the same way it gapped down is the same way it gaps up. You see that? So when you see these areas, these are the type of plays that you want to get into because you know you can risk a little bit to make a lot. So like the whole time, if I had entered right there, like right here, it would have been like this. I would have entered what right here. I could have kept my stop loss right in this green zone, right? And then I could have targeted the top of this red zone. You know what I mean? So now look, I'm risking 0.64 to make 173. So that's a 2.7 to 1 ratio. That's almost a 3-to-1 ratio. What I can win is almost triple what I would lose. You get what I'm saying? So this is what I mean. You always want to get in a place where you can see a very measured risk, a very defined risk, where you can define a small risk. So now we just let this play out, and you know it's just interesting to watch the way it moves. Like look at that drop right there. Look at how it came up right here, exactly to like the box, right? And then it dropped. You know what I mean? So it's like you got to understand, even though. So here's the one thing I'll say, right? Don't ever expect it to be smooth sailing. Price doesn't just go, oh, I'm just gonna go up. Oh, I'm just gonna go there. No, it goes up, then down, then up, then down, then up. Like expect price to retrace and make movements like crazy because it's still trying to find itself.
Did that like gap down?
Yeah, crazy gap down.
So is it mimicking the other gap down on the left?
Put it like this. If it were to go down, it would be a gap down. Do you get what I'm saying? So like it could have kept going up, but because there was selling pressure, it gapped down. Because there was strong selling pressure, it gapped down. Matter of fact, Miguel, do you remember how you called the gap on SPY?
Yeah.
Let me show you. Yeah, so you guys see how this. Let me just let this play out.
Yeah.
Yeah, so you know, and sometimes you guys can just watch the charts. You know, like go back in history and like make guesses, put your little position thing, and see how it plays out. Like this is crazy because the market's been crazy volatile. So it's like a lot of times you just got to take your profits because the next day could be crazy. So yeah, so that's that. But let me go to SPY. So I don't know if you remember, Miguel, we were right here. Let me replay this so I could show you where we were. We were right over here. Replay, marker, replay. Okay. Right here. Do you remember this day, Miguel? Oh, my phone.
I think so. Yeah.
You remember we were talking about the gaps. You were like, oh, so the price can come and claim this gap down here. And I said it
Oh,
could.
right.
I said it could, but it has to break all this buyers. It has to break through all these buyers first. So basically, if the selling pressure is strong enough, then it could fill the gap. And lo and behold, the next day, filled that gap. See that? That was literally, you just literally were saying that the day before it happened. So if you had that in mind and you played a put, what you could have done is as soon as it breaks, as soon as price broke this low, you could have hopped into puts. Why?
Right.
Because because it would have been a good risk to reward. That's why. So look, my risk to reward would have been like this. Short, I would have gotten in after this break, right? And then yeah, and all the lines are there. I'll erase some of these lines to make it a little bit cleaner. Yeah, I'll take this out. Erase some of these lines, make it a little cleaner. All right. Yeah, so it would look like this. I would have gone short right here, right on the break. I probably would have gotten it on the break of the body just to be aggressive. But let's just say I want to be safe. I'm gonna wait till the break of these lows. So I would enter right here. I'll put my stop loss right above this, a little bit right above this. And then I would have put, where would I put my take profit? Right at the gap. You know what I mean? I would look at this candle and put my take profit right at the gap. You see how I'm targeting the gap? You see that? So now I'd be risking basically 3.72 to make 6.23. So that's like a 2.1 ratio. You know what I mean? So basically I'm risking, I'm gonna win double what I risk. You understand what I'm saying? Does that make sense, Miguel?
Yeah. No, it
Yeah,
does.
and that's how you always want to trade. You always want to trade where you can make way more than what you lose. So now if you lose, it's not a big deal. And then you notice right after that, what the market do? So oh damn, I went too fast. That was a good candle right here. So okay, this is another example of a good trade you could have taken based off risk. So right here. So right here, you see this green candle right here? It has a small body. That means I can play off of it and make a small risk. You know what I mean? So what I could do at this point, I could say, okay, make two lines. Let me get I could make a line right here. And then I can make a line on the bottom, right? And those are my triggers. You know, I'll probably make my trigger even a little earlier, like right here at the break of this low. I can either do the break of this low or I can be extra careful and do the break of that low. But because it's such a weak wick, I would want to get in a little bit earlier if like off this low. You know what I mean? So notice that once price breaks either the high or the low of this candle or wherever my trigger is, that's going to be my trigger to get in. Because you got to understand now, no matter what happens, whether it goes up or goes down, I'm only going to risk this little area right here. You see that? I'm risking that little area right there. So if it goes up, I could target all the way up here. If it goes down, I could target all the way down here. Does that make sense to you guys?
Mm-hmm.
So that means that it's really good to get in on inside candles that are inside the range of the previous candle, because a lot of times inside candles lead to big moves. Like this candle right here led to a big move. This candle right here is inside. You see how this candle is inside the range of the previous? It led to a big move. So inside candles tend to lead to big moves. When you get a small inside candle like this, you have a small risk that could lead to a big move. So now you just wait, you see which way it breaks, and then you just go in that direction. As soon as it broke this orange right here, I'm in. I'm in for puts. My stop loss is above the high of this right here. You know what I mean? So this is how you trade based off of trigger signals and actionable signs. So like when we trade, we just wait for things to happen. And it's like, if this, then that. If this happens, then we do this. If that happens, then we do this. You know what I mean? So one thing I've been realizing is as the market's been going down, gold's been going up. Like look at gold. This is gold, by the way, guys. And it's been gapping. So Miguel, why do you think this gapped up right here?
Because of that let me see what day was that? That was a Thursday? Yeah. So it gapped up.
Mm-hmm.
So that gap right there and that
Yep, it gapped up today to fill. So this is called an imbalance. Like when you get those big impulsive moves like that, it's called an imbalance. When you get consolidation like this, it's called balance. You understand? So the market always moves from balance to imbalance. So balance to imbalance, back to balance, back to imbalance. You guys see that? Balance, imbalance. Balance, right? Balance, right? Imbalance. You see it?
yeah.
That's how the market moves. We want to trade during the imbalance, during the big moves. We don't want to trade during the balance because the moves are smaller and you got to be more on point. Make sense to you guys? So you'll notice a lot of times after consolidation, it always leads to a big move. So once you've seen this start to gap, so like I wasn't really watching that, but once I seen what I would have done, I would have made a range. I'm like, okay, I would say this whole thing is in this range, right? So the moment we break out of this range, that's already showing you something. Like that's already like a trigger to potentially play it up, right? If you looked on a small scale and you looked at this range, you could have looked at the gap up as that break. You know, depends on your tolerance, how much risk you want to take, you know. But that's basically the way it goes. So now that we're in imbalance, guess what's probably going to happen soon?
Balance.
Exactly. That's and that's the way it goes. Like literally, the way the market moves is the same way you breathe. This is the inhale, this is the exhale. Inhale, exhale. Inhale, exhale. And just like that, when the market takes a big inhale where it just keeps staying in a small range for longer and longer, the longer it stays in that range, the bigger the move is getting ready to make. You guys understand that? So now let's look at one of my favorite stock. Rig. Impulse. It made a big impulse to the downside. But notice that if you know candlestick patterns, you would have a high likelihood of being able to predict this move. So if you guys know, like, let me draw this right here. Whenever you see this right here, draw. It's called a double top. You guys see how it's like a double top, and then on top of it, it looks kind of like an M. You guys see that? So from early on, once you've seen it struggling up here, you could look for the double bottom to play the rejection. Anybody not know what double top is?
No.
Double top is when it hits the ceiling twice. The ceiling, the resistance is the ceiling. It has a hard time getting through. So it hit it once, got rejected, came back again, hit it again. Usually on that second rejection, it's gonna flush a lot of times. Let me see if I can show you.
Is that within a week or a day?
It could be this is daily. So every single candle represents a day. So this is like
Okay.
within several days, like maybe 2 weeks. You know what I mean? But the main thing is you can this stock moves so much you can make money in both directions because this is a huge move down from like 770 to 630. That's more than $1. You know what I mean? So you can look at it like the way I look at the numbers when they're little, pretend it's 778 and pretend it's a 630. That's a huge move. You know what I mean? So that's basically it. Yeah, I like the candlestick pattern. Yeah, it's a strong zone. So we got about like 2 minutes, but let me just find some more examples for you guys. So and know what to look for. So this is the double bottom, right? There's more. Like if I go back, so now I'm on the weekly chart, right? Or I know which stock has it. MRO. You see this double? You guys see the double top in this chart? Anybody see it?
Yes.
So that's what I mean. Soon as you've seen that double top, you could have already been looking for the sell. You don't go in right away and sell. You wait for this candle right here. It's a bearish engulfing. You see how this candle swallows up the green? This candle would have been my confirmation to get in. Once I seen this candle, I would get in on the break of probably the body or the low. And then from there, put my stop loss above this candle, small area of risk, and then target down here at one of these key levels. You know what I mean? But you see this gap, that means in the end, I could target this gap right here. You see what I'm saying? So you got to use the market structure to find your targets, find your entries, and to basically just find like areas to actually play off of. So do you guys kind of understand what I did here? So basically by using market structure, you guys can predict where price is most likely to go. But that's it for today, y'all. Thanks for tapping in. If you guys are interested in the recordings, let me know. And I also do my paid classes. Have a good night, everybody. Thanks for tapping in, David, and seeing a couple of y'all.
I appreciate it.
Yeah, no doubt.
Appreciate it.
All right, good night, everybody. Thanks. I'm gonna put it up on the call for those interested in the recordings. Peace.